And I was thinking that this distressed notes, a lot of people have confused on that. And people think that the mortgage payment who have failed to pay and it was taken by the bank. And then the investors come into the play and getting that for a discounted price. So is that a right term to that, or how are you seeing the term called distressed notes?
So when I'm talking about distressed notes, it's the mortgage. It's the 30-year mortgage that's on the property, right, that the borrower should be paying. And a distressed note is where somebody has not paid in usually 90 days or longer, you know. So that's when the bank starts to realize, hey, they start to accelerate things a lot of times to start the foreclosure process, to start the notice of default, filing the list pendants if you're in a judicial state here in the United States. So that 90 to 120 day period is where the banks then really start to ramp up and start that process. Now, not every bank will start it. Something like I just got in a list literally 5 minutes ago of over 700 non-performing mortgages, all first liens on a variety of mortgage products, whether it's FHA or VA or whatever like that aspect of things. 30-year mortgages and 40-year mortgages where the borrowers haven't paid in 6 months or longer in a lot of
Hmm.
cases. So the banks, and for every month that a borrower is late on their mortgage payment, it reduces the value of that debt. Okay. So usually if you're a month late or you're rolling 30 days late, like some people will take advantage of, that mortgage is worth 90, 95 cents on the dollar. So if you're a bank and you wrote it for $100,000, that mortgage, and now they're late by 30 days and it reduces the value of it, that's not good if you're a bank, right? It
Yeah.
reduces the value of your portfolio. And for every non-performing note you have, especially if it gets in default beyond 90 days, you have to hold money back in reserves to offset those losses. And that's how banks make money is they don't want to hold money back. They want to lend it out 10 to 50 times. They want to, that's how they make money. So for me to get involved, it's usually got to be where a borrower hasn't paid in 6 months or longer, because then it's a bigger discount for me. I can go then buy that mortgage, not the property, the actual mortgage at a huge discount, 30, 40, 50 cents on the dollar, just varies on or discount off the property value. And now I take on that responsibility as the lender. And then
Hmm.
I can still allow that borrower to get back on track, start making payments, allow them to do a short sale, allow them to sell a property, or go the route of foreclosure. I literally step into the bank's shoes and have all the same rights. And then I can go from there. But the fact that I buy it at a bigger discount gives me more flexibility because my cost basis on that note isn't 100,000, maybe 50,000. They owe 100. It gives me the flexibility to work with them to get them back on track and make a great return on investment for me. Does that make sense?
Yep. Wow. And Scott, I have to ask one more thing regarding this that
Sure.
Fed cuts the rates, right? So now 4.25, and which is directly impact on 10-year treasury bonds. So that one directly impact on mortgage rates. So right now United States rate is 6.8 mortgage rates, I guess. And will it come down based on this Fed rate cuts, and what do you expect from this?
So people ask me all the time about that. If I had a crystal ball, I would be in Las Vegas gambling right now. You know what I mean? Or betting on the World
Yeah.
Series. Okay.
Yeah.
But everybody I talked to, like I just got back from a big capital markets conference in Dallas with about 200 commercial investors and stuff like that.
Wow.
And um, the rates have just gone down. Everybody there is talking about the rates coming down anywhere from 0.25 to half a point by
Hmm.
the end of the year. Now that we're into the fourth quarter, they think that it'll drop down, maybe half a point. Well, is that going to affect interest rates? It'll affect them a little bit. It may stay the same. It may drop. Who knows what's going to happen, right?
Hmm.
The idea, the way I look at it, if you look at history, me being an old mortgage banker and mortgage broker back in the day, working for Chase and running my own mortgage company here, 6% interest rates were a pretty good interest rate. Everybody's gotten spoiled on having 2, 3%, interest
Yeah.
rates. 6% is high. Well, yeah, it's high compared to 3 years ago, but it's actually normal or below where it was 15 years ago.
Yeah.
So what's the biggest impact is the cost of housing. All right, the
Mm.
cost of materials. That's what you have to worry about. I think with rates coming down a little bit, you're not going to see a maybe impact everybody rushing to sell their house or people rushing to buy houses. I think you're going to have a controlled blip like we normally do during the summers, during the end of the year, people going and buying houses because they're looking to move because of jobs and stuff like that. I don't see a huge interest rate drop, a point and a half, or 1 point. I don't see that happening. I think it's to be a controlled descent a little bit. You'll have a little bit of uptick, but that really doesn't affect me being in the mortgage business of buying debt because I'm buying stuff that's already fixed rate stuff. That's not being affected by adjustable rate mortgage stuff like that. I'm buying something at a 6% interest rate. It's going to stay a 6% interest rate. If I'm buying at a 9% interest rate, where it was, that's what the note was written for. It's going to stay at 9% unless something happens.
Yeah. And Scott, when we discussed about mortgages and distress notes last time, it was an election period, the Trump and Kamala Harris. And right now, President Trump is in charge in the House. And how the economy is tough and how and where its impact on your business?
Nothing. Zero, zilch, nada.
Really?
I mean, yeah, zero effect because I'm not building a house. That's why I mentioned it might cost more to build because if we're importing lumber and importing other things, yes, you're gonna have some tariffs. The cost of building houses has gone up obviously than what it has 15 years ago. But we're already seeing, and this has nothing to do with Trump or Kamala Harris. We're seeing a correction in the markets taking place right now. I'll give you a great example. House right across the street from me. Okay. My neighbor this weekend walks up to me as I'm walking around here. He's like, "Oh my God, I can't believe they're selling that house for $438,000. It should be $500,000." And I looked at him. I said, "Yeah, it should be $500,000 if that's based on a year and a half ago. But the market's cooled. Prices have come down because people are motivated sellers are looking to sell stuff.
Yeah.
And you're always going to have that happen where a distressed seller or a motivated seller is going to drop their price to get a property sold, and that's going to affect the rest of the comps in the neighborhood. So we've seen that here in Austin, Texas, where I live. I won't say a crash; it's a correction. In some houses, and honestly, the average correction, and this is across the United States, so it's a general term. Don't get anybody mad at me, but you're going to see anywhere from a 10 to a 40% valuation correction in the negative cycle where values are coming down over the next 12 to 18 months. And it will vary on state, it will vary on economic and things like, you look at Florida, especially Southwest Florida, values have come down there for a variety of reasons, not only because of insurance costs and the huge amount of properties listed for sale, people who, all the Airbnbs or short-term rental properties that now can't cash flow because of increased insurance costs, people are selling those. That's causing the market to crash in areas, stuff like that. I mean, and then other areas of Florida are going to be strong. Miami's still strong. Only a 2-hour drive across Highway 75 on the Tamiami Trail or Alligator Alley, you're still going to see strong values. So it all's dependent on location. Don't be surprised that you're going to see a reduction in values like we already are seeing. And it's only going to affect you if you're trying to sell your house in probably the next 12 to 24 months. The markets will correct, values will go back up. But it's an opportunity. If you've got some cash or dry powder sitting on the sideline, you might be able to pick up a deal that's going to appreciate pretty well if you're willing to hold on to it for 2-3 years.
Yeah.
The biggest group that's really being affected, Ash, is your fix and flippers. Your fix and flippers, have often gone by the 1% rule, where they want the rent payments to be 1%, of what you're purchasing for the property. You can't do that these days. You've got to be at 100, 1.25, 1.5. Of what you purchase the property for because of increased insurance costs, increased labor cost, increased cost to build. So you've got to understand and adjust your numbers. That's the biggest impact I would see. And honestly, tariffs, yes, they're going to have a little bit of impact. I mean, everybody gets their underwear up their ass, all pissed off about all these tariffs. I'm like, listen, you got to realize it is a play. It's a political play. Will we see some increased costs? Yeah, and others, it's a correction. Honestly, I don't think it's a long-term issue. Just sit around and hang out for a little while.
Yeah.
I mean, if you're worried about the price of your coffee doubling, it may very well do in the short term.
Yeah. And Scott, I was thinking about this housing market from the consumer side and from the commercial perspective. So from consumer side, so let's say I have some statistics from the Department of Statistics that the salaries have raised 20% from 2020 to 2025. And the mortgage rate 2 to 6.8% right now. So there's a jump in mortgage rates from 30 to 34% from his salary, and from 12 to 13% to 34 to 36 somewhere. So
Yep.
this rate is very increased. So from the point of a person who is trying to get the mortgages and repay that one, and over a period of time, at the same time, asset also keep appreciating. True, and he will refinance and solve the assets. So at that point, how it can be an impactful when the keep rate is keep increasing and the price appreciation is high and the salaries are keep increasing but in a lower rate.
So what you have to realize too, yeah, I mean that's kind of a microeconomic snapshot of just the last, if you look at the last couple of years of things. Yeah, things have been hectic. Here's the thing. One thing is that we need affordable housing no matter where it's at here in the United States. Okay. Most of the homes being built are not first-time home buyers. They're that second, third tier. Unfortunately, we have a lot of people that don't want to buy, your 3-bedroom, 2-bath, 1,500 square foot house as a starter home. They want to buy that 2,000 or 2,500 square foot house that's 400 to 500,000. Now, median cost of real estate here in the United States is about $400,000 that's average across the places. It's There was statistics done a few years, well, actually last year I think we did it, where roughly if you look at the 105 or 110 largest markets across the country, it's more affordable to rent than it is to buy in roughly 70% of them. Okay. So in a lot of places, it's unaffordable to buy a house just because salaries aren't keeping up with it, or your first-time home buyers aspect, you just can't afford it. You have to reset your real estate. Maybe you need to move somewhere that's more affordable than trying to live in Miami and live in La Vida Loca, all right, or
Yeah.
keeping Austin weird. You got to understand that cycles change, and you have to reset your expectations. Maybe you've got to rent for a while. Rents are actually coming down in some of the areas across the country. Because there is a glutton of inventory, especially looking at like here in Texas and also Florida, we're seeing some of the biggest rent declines because of the overbuilding. Other areas where there wasn't that much construction done, you're seeing rents going up. More importantly, you've got to look at what you can and can't afford and be realistic. That's the biggest thing I think it comes down to versus just saying everything about the United States. Is look at where you live. Is it affordable? Is it unaffordable? Maybe you've got to commute 30 minutes to get a better house, more affordable house than living in the city. It's like anything else. Like it's kind of like what we saw going back into 2008, 9, and 10. You got to tighten your belt a little bit. Maybe not play so much with the toys, eat out less. The thing that I'm concerned about the most is that we've got record defaults in credit card debt, student loan debt, and then also auto loan debt. I mean, the price for a new car is just ridiculous these days. Or the average car payment being over $700 a month.
Wow.
I mean, that's ridiculous.
Yeah,
But we're
horrible.
also seeing a huge amount of those defaulting because people can't afford them. So you've got to set your realistic expectations. Maybe dial it down a little bit. You're not buying the brand new BMW, buying the brand new Kia Sport. You know what I mean? For a little while.
Yeah. And Scott, when we talk about the real estate, that a lot of
Yep.
people are trying to purchase a house with the land, and some people are trying to move with the flat and all. So, what is the strategy behind this, and what is the return on investment on these two things in the same kind of a place?
Honestly, it's going to vary state by state. Texas, you're going to have to look at if you're buying a home on land, are you talking like an acre or more? Or are you talking like 10 acres or more when you say with land versus like a condo or townhome? Can you
Yeah,
describe
yeah,
that a little bit
it's
more?
a condo because a condo like of thing.
Okay. So when you're looking at things, condos, especially here in the United States, are really taking it in the teeth right now. I mean, um, with the nice thing about moving to a condo is you have less yard work, less exterior maintenance, but you do have the HOA fee, the condo association fees. In some cases, specifically in older condos, you may have special assessments that could be $500 extra a month, or even a surprise 10,000 to 100,000 special assessment areas like Florida where they need some upkeep. Versus buying a single family home, it may cost a bit more, but you have that less HOA fee, but you've got to take care of the property. You got to look at where you're located and everything that's involved with that purchase. Cost of gas, how close are you to amenities, and what are you trying to do? If you can work from home, it's not a big deal. I would get outside the country, get some fresh air, unless you're in New Jersey and you're just smelling the refineries. But if your job requires you to be in, then you probably want to be close to it. We are starting to see more and more people kind of pairing up, adding roommates, two families coming together to share the expenses. I mean, that's, people moving back in with their parents to be able to afford things for a while. I just think one of the things I think that's going to happen the most in the next few years to help with a little bit of affordability And we've seen this already take place with like Fannie and Freddie doing modifications. And what am I talking about is that I think you're going to see a much more prevalent where instead of being a 30-year mortgage, you're going to see 40 and 50-year mortgages to make homes more affordable to people because they'll stretch it out longer, right? We're already seeing that, like with all the modifications from COVID, where Fannie and Freddie were modifying loans from 30 years to 40 years to give people some relief. I think we're going to see that be an upkick. I mean, if you think back, the 30-year mortgage has been around since what, about 1985, I think is when it first came out.
Hmm.
Before that, it was like a 15, 20-year mortgage. So it's time for an adjustment because prices have gone through the roof. I don't think interest rates are going to affect that month. I don't, it may drop a point here, there, adjust a little bit here and there, but you've got to do something to, when you look at the price of real estate going up, even though sellers are going up, the price of goods, the price of housing is far exceeding a lot of things in a lot of places. I mean, what is it? I think it's, you shoot for 3 times your salary. Well, and there's only a few places in the country where homes are 3 times an annual salary for the most part. Most of the time, it's 7, 8, 9, 10 places in most of the desirable areas.
Wow. And Scott, when we talk about the property last time, there was a boom in Bitcoin. The prices was like hiking like 100,000 plus, still in a stable position, and it's coming a bit lower and higher. And right now the AI boom is going on. It's like a dot-com bubble, some says, and some says the bubble will pop up in few months, and but still the momentum is there. It's earning a lot. And how this AI impact on housing market? Do you see any signs of that, or is just a kind of a bizarre that's going on?
Okay, so let me give you a little bit of something. There was an article out recently from a Spanish company. A Spanish company sold over 500 or it was either 50 million or 500 million dollars in real estate using an AI agent. Okay. People went on, they got their, the qualified paperwork, they filled out their application, they filled it, and an AI agent interviewed them, what they were looking for, and went out and found them the right properties and sold these condos or whatever, like across the board. No agents, okay? No mortgage brokers except for a few. So what's going to affect it in real estate isn't going to be more the value side, it's going to be the jobs. And if you're a realtor or mortgage broker, out there, you need to understand that you've got to figure out ways to differentiate yourselves, because a lot of these iBuyers like Redfin and other things like that, their purchasing price of going out and buying properties and trying to do that stuff backfired because they overpaid for assets. They can't cash flow. But what's going to happen more so is if you're a real estate professional, you better learn how to market. You better learn how to accentuate yourself for the thing, because it may not be immediately, but in the next 3, 4, 5 years, I think you're going to see more and more agents disappearing, because more and more people are going to be using AI to find real estate, to qualify themselves. There's going to be companies out there helping you find things. And some of those things are already in the works right now here in the United States. I mean, I've already taken all my information and made a complete digital clone of myself. I mean, you can literally go on to my clone, ask it questions, and I'll answer it back in either text or phone call to you in my voice, and ask any questions you want about distressed real estate or stuff like that. It's pretty freaking awesome, but it saves me a ton of time of asking questions. I think you're going to see a lot more of that taking place. I think some people are scared, some people still like that, but what's I think has caused more problems here in the United States.
When we talk about the AI more on it, so it saves a lot of your time there, and how its impact on return on investment when we see in a physical way. So just now it started, we know that, and so as you mentioned, the AI agents and the clone that you made yourself to make your time easier and yourself easier, and where its impact on return on investment in real estate.
So in practice, it's going to save time, have less overhead. You're going to have faster decisions made. People are going to be able to find things. It's going to speed up the process of getting deals sold, and also eliminate a lot of the people need. You're not going to need somebody to go out and take your phone call to qualify you. You're not, an AI can immediately go on to the MLS and find the exact assets, 5 or 10 that you need to be looking at, and find those opportunities. It's also helped. It's like been a huge ROI for me, because I could actually upload a full loan file and it could do due diligence in a matter of minutes versus taking 20, 30, 40 minutes for stuff like that. The fact that it's freed up my schedule and saved me hours of time instead of talking on the phone people are spending time talking to my AI clone because it's literally got millions and millions of my words, my videos, my blogs, my book in it, my classes, so it can help answer questions correctly. And I can always go back in and tweak it. But it's made a dramatic impact on saving time and saving money that you would not be paying, and even an assistant or a virtual assistant. It's been a huge impact. In fact, to be able to find deals faster without having to do a lot of direct mail and using Zillow Street Views for a lot of investors out there, they're using AI to help them find better deals faster.
Yeah, and there was a comment from the last episode that I have seen in I think in YouTube, that a person is asking that his salary is $10,000 per month, and he can save up to 4,000 from the salary every month, and he don't have any debt, and from where he can start the real estate investment.
I'm sorry, you got to rephrase that question. He's working full time. I didn't understand the question.
Yeah, he's getting a monthly salary of $10,000, and he's able to
Okay.
save like 40% from his salary, and he's
Oh, he's able to
asking,
save $4,000.
yeah,
Okay.
yeah, and he's
How can
asking
he get
from where
started?
he
Is what
can
he said.
start. Yeah,
Okay. So the first thing you should do, you should get educated. That's the first thing. No matter what type of niche of real estate investing, go get educated. That means either A, attending workshops and niches that you're interested in, and B, going to your local real estate investment association. Okay, because $4,000 isn't going to buy you a lot, right?
yeah,
The great thing is you don't need to use your own money to buy real estate. There's other vehicles, either hard money lenders, private money lenders. And so you got to understand the financing part of real estate, even subject to deals or taking over mortgage payments on a distressed property. There's a whole variety of different ways to finance things. So you don't need to save all the money yourself to go buy the deals. Go network, go get educated on the different types of financing, and go network with local investors, local hard money lenders, local private investors at your local real estate club. That's the two places I would get started right off the bat. Go learn, get educated on the different financing types. Go learn about private money. We've got some great videos about raising private capital, because there's a ton of money sitting on the sidelines of investors waiting to put it to work, but they need somebody to bring them a deal that they'll finance.
yeah. And Scott, there are a lot of approaches from REIT, Real Estate Investment Trust, and it's a kind of a mutual fund for real estate. You know that, and how the things work behind it, and a lot of people are invested on it, and people are looking for more comfort, like a share market and investing and just sitting out and getting the profit from that. And do you think these prices can go up and down, or how you seeing the rate?
So I think it becomes all of researching. Every REIT is going to be different in what they're looking at, different asset classes. You got to look at the management, the fees. What's being hurt right now is a lot of multifamily REITs, real estate investment trusts, that invest in a lot of multifamily deals. A lot of multifamily deals are not doing very well. So those REITs aren't doing very well. So invest in an asset that you know. That's one law that's always been told by me, by all my advisors. Only invest in something you understand. If you don't understand the asset class or how the fund works, don't invest it. Go find something that, find a fund or find an asset class that you understand. Take the time to learn the ins and outs. And that way you won't be surprised if the market goes up or down. That's the biggest thing. People complain. And I always ask them, well, you invest in this. Did you do any research on the fund? Have you taken any apartment investing classes or evaluated the REIT, the management? No, somebody told me it was good. Well, that's kind of on you then. You got to do research on anything like you would.
Yeah. And Scott, we seen that the gold price is hitting a peak in ever, and it's a history. And so any correlation between the gold prices and the property prices?
I don't think so. I don't know. I don't spend a lot of time on that aspect. I'm the wrong person to ask about that. But I mean, gold's going up, real estate's going up. I mean, you can't buy a home with a gold block. You know what I mean?
Yeah. And
gold bullion,
Yeah. And real estate being a very boom, and it's being in a market like United Arab Emirates here in Dubai, it's going a very peak level. The prices are way more higher, and the prices, like when we compare the last year with this year, I can see clearly that 50% of the price hikes are there. And this, some people say it's a boom, and some people saying it's a bubble. and compared to other cities like United States and Austin, Texas, you are from, and those areas, the price increase we can see 30-40%, but 50-60 is looks like a bubble. But I have no idea. Maybe the supply side shortage or the demand is high. And how you're seeing the whole worldwide the real estate property price hikes these days?
Well, I can only talk about here in the United States, not worldwide, but I'm going to tell you right now, prices are going to be coming down as we're going to see. We've got some economic studies that we pull that in the 855 biggest cities in the country, most of them are going to see a 10 to 20% valuation correction. It means prices going down just because of all the other economic issues. You can't put a blind eye to default rates across the country and other types of classes. VA loans are at record defaults. FHA loans are at record defaults. People can't afford because they're overpaying on a variety of other facets. So you're going to see a reduction because that's just where it's going to go. It's going to bring property down. Like I said before, it'll vary on a market by market basis. And even a city block by city block where demand is still high versus demand being low. I don't have that crystal ball, but I just know what I see economically wise and trends, you're going to see a reduction in values or correction in most markets.
Wow. And Scott, we have seen that the new people are coming into market, that startups, and they are into real estate. And we have met some friends also that they have owning like 4 to 5 properties, and they are trying to scale it up. And what is your advice for that kind of people who are already in investment of property, and they are trying to scale up in the future? And some people are, I have seen and met that they're still waiting for the perfect moment. But actually, myself, I know that we cannot wait for a perfect moment, and economies keep going up and down. But we have to be sharp in the investment portfolios. And what is your advice for those kind of people who are waiting for the perfect moment?
Well, you asked me two questions. What's the advice to those that can scale versus those getting in? Which one do you want me to answer first? Here's the thing. Get educated. If you're looking to scale, you have to invest and double down on the financing side and raising capital and the marketing side. You're going to see more deals coming across the board. You can't wait for the perfect deal where everything is absolutely perfect. That deal doesn't exist. Okay. So, raising capital and marketing is where most of my colleagues that run big firms, they're big, they're closing on 50 to 100 properties a year, not 5 in 5 years. They're doubling down on the marketing side. They're doubling down their expenses, and they're being as lean as possible. They're not going for the high-end upgrade on the rehab. They're doing a scale below that because that's where it makes more sense financially wise for them. If you're looking to get into the game, get in the game. You're going to learn more in investing in real estate by doing your first deal. You don't need to use your own money. Go get something, buy a small deal. Just get your feet, dip your toes in the water and get started. That's all I can say.
Wow. And when we talk more about the distress notes, that how the market is right now, it's all in prediction right now, or how you seeing the market?
Well, the third quarter is usually a slower quarter for us in the distressed note space, and now we're entering the fourth quarter here starting tomorrow. I've already started to see more increased distressed stuff coming to market where the banks are like, okay, it's the fourth quarter. We need to get this off our books next 3 to 6 months. So I expect us to see a huge amount of distressed debt hitting the market. It's not like it was back in 2010, but a sizable amount. My sources tell me they were waiting for the fourth quarter to move stuff. So that's what we're looking for. We're pretty excited about what October, November, December of 2025 are going to hold in even into Q1 of next year.
Wow. And we can see some headlines that the Vanguard and the BlackRocks, they are more into investing on real estate in United States especially. And will it impact highly on mortgage rates, or not in, sorry, mortgage rate, but in the housing prices?
Yeah,
Because of
I mean, it will.
because of
You're gonna have people.
high demand from commercial side?
Yeah, I think you're going to see some more of that. They're going to overpay in some cases because they've got a lot of money, cheap money. Their money costs them 1-2%. That's cheap money to go out and buy stuff they can overpay. So if you're selling a property to a BlackRock or something like that, you'll probably come out pretty good. But if you're trying to compete, you really need to focus on that off-market stuff, that distressed stuff that's not hitting the MLS that they're not targeting. So that's why I like this distressed debt side of things, because we're seeing deals 6 to 12 months ahead of everybody else.
Wow. And Scott, What is your advice for the people who are watching this podcast and they want to be like you? And you are started in 2008 and right now 2025, and it's a big career, and you are coaching for and teaching for the students for more than 20 years, and you invested more than 1 billion US dollars, and you are here. And what's your advice for the people who are watching at this podcast, and from where they can start, and how they should be focused on this trend?
Well, get started. Don't wait around another 14, 15 years to get started. Get started doing something now. I started off by going to my local club and going out and knocking doors, talking to people that were facing foreclosure, sending out stuff. If you like notes like I do, you got to get started. And that's why we offer a free class. We have a one-day class called noteweekend.com. It's a free 3-hour course for you to dive in and learn how we find, fund, and flip these notes. It's a great starting point. And then, of course, we have a regular 3-day class that we teach once a quarter coming up in November. So if you'd like to find more about that, you can go to notebuyingfordummies.com. But take the free class. It's a great way to get your feet wet, get started, see what's go attend your local real estate club, find out what's working in your market. And if stuff isn't working in your market, find out the markets that your local investors are buying stuff in. So go network, talk to people, use LinkedIn, connect with investors, and find out what's really working in today's market and stick to that and get educated on whatever it is.
Wow. And Scott, I'll put the detail on the description below. And Scott, we are near to exit. And I want to ask one more question that maybe it's not appropriate or not. I don't know, essential with the real estate.
Ask
But
me.
but now the share market trend, most of the people are investing on AI. Everywhere is AI, artificial intelligence. Even the new iPhones launched, they are saying Apple intelligence from their side, and AI. So people are slightly turned to that side for the investment, especially in big companies and all, always buying Nvidia stocks or Google Alphabet, or going for Apple Incorporation or Tesla, and the people going behind the crowd right now. So what is your advice for the people who are going behind it, that leaving the real estate?
You know what? If that's what they found that's working and that's the route they want to go, that's completely okay. Here's the biggest thing when you have to worry about AI. We don't have the technology, we don't have the infrastructure in place, power grids, water grids, and stuff like that, to be able to furnish all these AI companies that are trying to do things. So if you can invest in infrastructure or invest in different data systems, data markets, data buildings, I mean, that's something I've looked at a little bit, but focus on getting the ball wet. If you keep waiting around for the right time to do it, it's going to pass you by. So for some folks, they're getting started early, which is great. Others are diving in and where to go. You just got to get educated. I'm not going to tell you how to get started or advice on AI. I have what I do. That's what I do. I don't give advice. I try to give counsel, because advice is like assholes. Everybody's got one. Doesn't mean that they're good at it. You know what I mean?
Yeah. Wow. Thank you very much, Scott.
Thank you, Ash. It's been a pleasure.